Welcome to The Explainer, where we take complex topics and, well, we make them make sense.
So today was a big day for the Indian stock market. A huge psychological milestone was hit. After 7 straight days of gains, the Indian Nifty index closed just a tiny bit above the 25,000 mark. First time ever. On paper, that sounds like a reason to celebrate.
Because here's the thing. Despite that big headline number, people on the ground were calling the trading session choppy, even subdued. It turns out the real action, the stuff that really mattered, wasn't happening in the broad index at all. Nope. It was playing out in the individual stories just beneath the surface. And that's exactly what we're going to unpack.
Okay, let's get right into it. The biggest story of the day wasn't some high-flying stock. It was actually a potential rule change that sent some pretty major ripples through the whole capital market sector. Word on the street is that the market regulator, SEBI, is getting ready to release a consultation paper. And the topic? They're thinking about getting rid of weekly derivative expiries, with the end goal of moving the entire market to monthly contracts only. I mean, that is a massive potential shift. So let's just make sure we're on the same page. F&O contracts are basically financial tools that let investors bet on where a stock or index is headed in the future. And these short-term weekly options have just exploded in popularity lately, especially with smaller retail traders. And that popularity is really at the heart of the whole issue. You see, the regulator is worried that way too many small investors are losing a lot of money on these really speculative weekly bets. A product that was first brought in to help manage risk has kind of turned into something else entirely. And you could see the impact almost instantly. As soon as this news got out, shares of brokerage firms like BSE and Angel One took a sharp dive. And it makes perfect sense, right? A huge chunk of their revenue is tied to trading volumes, so a move away from weekly options could really hurt their bottom line. So this has really kicked off a debate between two very different ways of thinking. On one hand, you've got SEBI's idea, which is maybe just get rid of the product altogether. But on the other hand, you have experts saying, hang on, what if we just make it a bit harder for the small-time traders to get involved?
This alternative idea is all about raising the barrier to entry. The argument goes like this. If you require a trader to have a minimum balance of, say, 100,000 rupees, you'd protect the most vulnerable investors. But, and this is key, you wouldn't be taking away a tool that bigger institutional players actually find pretty useful for hedging their portfolios.
All right, so moving on from the regulatory drama, the market was also being shaped by two huge corporate deals, and they tell these fascinating and totally opposite stories about risk and reward. First up, we have Tega Industries. They announced this absolutely massive acquisition of a company called Molycop. And when I say massive, I mean the company they're buying has a market cap almost as big as their own. And they're planning to pay for it with a leveraged buyout, which basically means using a ton of borrowed money, with some help from Apollo funds.
The market's reaction? Well, let's just say it was cautious. The stock went down. Investors are clearly getting nervous about the sheer size of this deal and the mountain of debt the company's about to take on. It's a really bold bet, and right now, the street seems to think it might be too big of a pill to swallow. Now let's do a complete 180. Shares of the drug maker Aurobindo Pharma actually surged today. And why? Because news broke that a potential deal for them to buy another company, Zentiva, was officially dead.
In this case, you can almost hear the collective sigh of relief from investors. They had been really worried that the acquisition would put way too much strain on Aurobindo's balance sheet. So this relief rally is just a powerful reminder that sometimes the smartest move a company can make is to just walk away.
So with all this going on, where are the professional investors seeing the real opportunities? Well, we can kind of break down their focus into 3 key areas that are getting a lot of attention right now.
Overwhelmingly, the experts are really bullish on themes that are tied directly to the Indian consumer. The big 3 that keep coming up are the upcoming festive season, the whole electric vehicle revolution, and of course, the incredible rise of the platform economy.
One fund manager even said his team is literally on the ground in states like Uttar Pradesh, and the feedback they're getting is crystal clear. Retailers are stocking up, and they are stocking up aggressively. They're expecting a huge surge in spending, partly because of recent GST cuts that put a little more cash back in people's pockets. And on that third theme, the platform economy, one expert shared a really simple but powerful 4-step framework for looking at companies like Urban Company or Swiggy. First, he asks, does it offer convenience? Second, can you make money from that convenience? Third, is it for a mass audience? And finally, the real kicker, is it easily replicable? If the answer to that last one is no, then you might just have a winner on your hands.
So what's the big picture here? Let's try to boil down this quiet but actually very eventful day into the most important takeaways.
Okay, first thing, headline numbers like Nifty hitting 25,000, they just don't tell the whole story. Second, these potential regulatory changes can shake up the market way more than the day-to-day index moves. And third, it's really those individual company stories, the giant bets and the smart decisions to walk away, that are driving the big gains and losses right now.
And all of this leaves us with one final thought. What we saw today really highlights this fundamental tension in the market, right? It's this constant push and pull between the top-down rules designed to keep things stable and the bottom-up actions from companies that actually drive growth and create value. How we balance those two forces, well, that's probably going to be the biggest story shaping this market for months to come.